The Kenyan government is seeking to raise 50 billion from these two treasury bonds that have been listed for June. Yes, this time they were listed late, but at least they're here. So in case you're interested in investing in either of these two bonds, here's a breakdown of how your money is going to look like. We have the first bond, the FXD 2020-15. So if you're going to invest in this first bond, it's going to go for 9.7 years, around 10 years. Yeah, it's going to give you a coupon of 12.756%. This is the interest rate. In terms of how much you're going to receive, how much you should expect to make from this bond, assuming that your investment is 1 million. So 1 million times this interest rate, then you take away 10%, which is tax. So you're remaining with 90% of your interest. So every year you're going to be making 114,804 shillings every single year for the next 9.7 years, 10 years. Actually, this bond is going to be paying out interest in August and Feb. I forgot this bit. In August and Feb. So this 114,000 is going to be split into two, 6 months apart. So in August and in Feb, you're going to be receiving 57,402. This is in August, this August. We are in June. July, August. So in 2 months, you're going to get this. Feb next year, 2026, you're also going to get 57,402. Then August, the same amount. Feb, the same amount. So the total return on your investment, if you're going to hold this bond for the next 10 years, is that you're going to make 1.1 million, 1.148040. This is how much you're going to make out of the 1 million. This is for sure, this is guaranteed income. In terms of how much you're going to pay, there is this concept of accrued interest. So this bond is going to pay you in August, but you're going to receive an interest that is worth 6 months. So those 4 months that you don't deserve the interest, but you're still going to receive it in August, since you're going to get 57,402, you have to pay that back as you pay for this bond. So that is accrued interest. Interest that you don't deserve, but you're still going to receive it in August. So you pay for it earlier on when you're paying for that bond. The accrued interest is 4.4156 shillings for every 100 shillings. So what about your 1M? This is this one is a must. This one is definitely a must, and you must pay this. So this bond can be sold at a discount. That is, you can pay an amount that is less than 1 million in the beginning, and at the end of the 10 years, you're going to get 1 million, because 1 million is your investment value. So there's that. It can go at a discount. It can go at 1 million. You can pay the exact 1 million, or you can pay more than 1 million. So that means like you can pay, for example, 1.1 M. There's that extra 100K. But at the end of the 10 years, you get 100K. So you've lost. So that number, we're going to represent it by with X. That number. It can be a positive. It can be a negative. It's a positive if you pay less. That is, you pay, let's say, 990,000. This X is it's a negative if you pay more. So how much you're going to pay is going to be X plus the 1M plus this amount, 44,156. This X can be a negative or a positive. Let's do the second calculation. The second bond is going to go for 15.7 years. So this is around 16 years. Do you have the patience to wait for 16 years? The return is 12%, so it's slightly lower than the first bond, definitely. So this one, most people are going to choose this bond, because I noticed that most investors look at interest. They look at the interest rate. There are some who look at the duration, but for some, the interest is the factor that they look out, is one of the factors that they look out for. So, of course, with 1M times this 12%, you take away 10%, which is tax, so you're remaining with 90%. Every single year, you're going to be receiving 198,000 after everything. This one is guaranteed. Guaranteed. This amount is going to be split into two. Again, this bond is paying in August and Feb, so they are quite similar. In August, you're going to receive a lesser amount, half of the amount, 54K. Feb, 54K. August, the other year, 54K. Feb, 54K. So times the 32 periods. 32 periods are these 15 years. Let's say they're 16 years times 2 because the payment is done twice a year. Or you can just say 108,000 times the 16 years. It still gives you the same answer. So this is in terms of what you'll receive. This one is guaranteed, this bit. But in terms of what you're going to pay, it's not guaranteed. When you look at this bond, the accrued interest, the one in the paper, is 4.3846. So for every 100 shillings, you're going to pay 4.386 that you don't deserve because it's paying in August and you're investing in June. So we have July, August. We have 2 months. So you deserve 2 months. The 4 months, 4 months worth of interest, you don't deserve it, which is represented by this number here. If for every 100 shilling, you have to pay 4.3846 or about $1 million. This one is the guaranteed amount that you have to pay plus X. You can pay 1 million. That is your investment value. Plus this one is also guaranteed. The X is the discount, the premium or the par. Discount is when you pay less for this bond. You pay, let's say 990K. So with 990K, you've benefited with 10K. 10K, yes, 10K. So 10K is the discount you've benefited. It can be at par. At par means just the 1 million, or it can be at a premium. A premium happens where it's in high demand. Remember, it's the market that determines the rate. It's what most people are willing to pay for this bond that sets the price for this bond. So it depends on how the market is going to behave. That's why if it's on high demand, there's a likelihood that you pay a higher amount because everybody is willing to pay a higher amount. Let's say 1 million, 1.1 M. Though I highly doubt that this one is going to be sold at a premium. Several things that I have noticed. One is that the June bond came late. Normally, bonds are listed the previous month for the next month. So for example, the June bonds were to be listed in May, at the end of May, so that when you are transferring your money, it's in June. So it's a June bond. But this time they delayed. That is the first thing. The second thing is that the interest rates have been going down because now we have 2 bonds that have hit the 12% mark. While for the prior months, we had bonds that went to as high as 14. There was one that was going for 14.1%, and it was the longest one. There was that bond. So, of course, the interest rates are going down, and it's not just in the bonds. For the first time since October 2022, we've had the Treasury bill rates, that is the 364-day Treasury bill rate, go below 10%. Now, the one for 364 days usually has the highest return out of the 3. It went below 10%. So it's not just in the bond market, the Treasury bill market, but it's also in the banking market, the loan market, because yesterday the Central Bank of Kenya reduced the central bank rate. It's the rate at which banks use as a benchmark to give loans to people. So the fact that we are seeing all these rates going down, it's also expected that the June bonds are also going down. What's interesting is last year, if you had invested in these bonds, you would have had the benefit of 1, going for short-term bonds, and 2, getting a higher return on those bonds. Let me just show you the bonds for June 2024. Last year at a time like this, we had 4 bonds that were listed. And you can see that the first one was going for 1.2 years. The other one was for 2.6 years. The other one was for 4.1. And the other one was for 8.7 years. And the returns on these bonds is that we have one that was going for 6.9%. We also had another one that was going for 18%. Right now, you're still enjoying those benefits. You're still getting your returns at 16.84, at 14.1, while these bonds right now, they are going for 12.756 and 12%. The returns on these bonds are low. But what's the alternative? The alternative is to do something riskier. The alternative is to do business or invest in physical assets. You can also invest in the shares market. You can also invest in special funds. I have noticed that a number of investors are moving to special funds, especially if you have like 250K and above. But if you're comfortable with these returns, with 12.756% and the 12%, you can go ahead and invest in this bond. Or you can just wait and see what July has in store for us. What do you think about these returns? Would you invest elsewhere other than these bonds if you had this money? I'd love to know your thoughts in the comments.